Every 2 weeks, money appears in your bank account, and within 72 hours, most of it is gone. Not because you are reckless, not because you are irresponsible, but because the system that delivers your money to you was never designed to make you wealthy. It was designed to make someone else wealthy. And the strangest part? You helped build it. But the real answer is far stranger than you think. Your salary is not a reward. It is a mechanism. And once you understand exactly how that mechanism works, you will never look at your paycheck the same way again. Let us start at the beginning. In the late 1800s, industrialists faced a problem. They had factories, they had machines. What they needed was a reliable, predictable supply of human labor that would show up on time, stay in place for 10 or 12 hours, and then go home and come back tomorrow. The challenge was not finding people who needed money. The challenge was designing a payment structure that would guarantee they kept needing it. Enter the weekly paycheck. Before widespread wage labor, most people in agricultural economies worked on cycles tied to seasons and harvests. You worked hard, you stored value, you survived winters. The rhythm of money was long and irregular. The weekly wage compressed that rhythm into something short and predictable. You work this week, you get paid for this week, you spend this week, you need next week. The economist Thorstein Veblen wrote about this in 1899 in his landmark work, The Theory of the Leisure Class. He described what he called conspicuous consumption, the tendency of people to spend not based on what they need, but based on what signals status to the people around them. Veblen noticed that as wages rose, spending rose to match them almost immediately, not because people were foolish, because the social architecture of spending is built to absorb every extra dollar you earn. This is not a character flaw. It is a system design. Now think about how your paycheck actually arrives. In most salaried jobs, your pay comes every 2 weeks or twice a month. This is called a bi-weekly or semi-monthly pay cycle, and it was standardized not for your convenience, but for the convenience of payroll departments, banks, and the businesses that profit when your money moves. Here is what that cycle actually does to your brain. When a large lump sum lands in your account, your brain registers an abundance signal. Psychologist Daniel Kahneman, who won the Nobel Prize in Economics in 2002, spent decades studying how humans process gains and losses. His research showed that the pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. But here is the flip side of that asymmetry. When a large sum arrives at once, it feels like more than it actually is. You round up, you feel richer than you are, and you spend accordingly. Then 3 days later, your rent is due, your phone bill comes out, your credit card minimum hits, and the number in your account collapses. Your brain registers a loss signal, you feel poorer than you were, and you spend conservatively until the next paycheck arrives and the cycle resets. This is not budgeting. This is not personal finance. This is a psychological loop that was baked into the payroll cycle long before most of the financial products you use today even existed. Now here is where it gets stranger. Your employer does not pay you everything they owe you on the day you earn it. They hold it. In a bi-weekly system, if you earn $100,000 a year, at any given point in a pay period, your employer is holding somewhere between roughly $2,000 and $4,000 of your earned wages that they have not yet given you. Multiply that across every employee in a large company. The float, meaning the money sitting in employer accounts waiting to be distributed, is an enormous pool of capital that earns interest for the business, not for you. This practice is so standard that nobody questions it, but think about what it means. Your labor created value on Monday. You received payment for it on the 15th. In between, someone else was earning a return on your work, and it does not stop there. Your salary comes to you pre-taxed. Before you see a single dollar, a portion has already been routed to the federal government, to state and local governments, and to Social Security and Medicare contributions. This is called withholding, and it was introduced in 1943 under the Current Tax Payment Act, largely championed by Beardsley Ruamel, the chairman of the Federal Reserve Bank of New York. The official justification was war financing. The practical effect was that workers never felt the full weight of their tax burden because the money left their hands before it ever touched them. Behavioral economists call this pain avoidance by separation. When you never hold the money, you never feel the loss of giving it up. Now your after-tax paycheck arrives, and what is waiting for it? Fixed costs. Your rent or mortgage designed to consume the largest single portion of your monthly income. Your car payment, a financial product that barely existed a century ago, but now averages over $700 a month for American buyers. Your insurance premiums, your subscription services, your minimum credit card payments. These are not random expenses, they are engineered recurring charges that were specifically designed to auto-collect from your income the moment it lands. The subscription model, now the backbone of modern consumer software and entertainment, was explicitly designed by companies like Salesforce and Netflix to create predictable recurring revenue. Your spending was their predictable recurring revenue. Your monthly outflow was someone else's monthly certainty. This is not a coincidence. It is architecture. And then there is the raise. You have probably heard the phrase lifestyle inflation. It describes the tendency for spending to rise in proportion to income. But lifestyle inflation is not a personal weakness. It is the product of years of deliberate social conditioning. Every time your salary increases, the market adjusts to absorb it. Landlords know what salaries look like in a given zip code. Car dealers know what monthly payments a given income can carry. The financial system calibrates itself to the maximum amount of money you are likely to receive and builds products priced to consume all of it. Elizabeth Warren, before she became a senator, was a bankruptcy law professor at Harvard. In her 2003 book, The Two-Income Trap, co-written with her daughter Amelia Warren Tyagi, she tracked something alarming. As dual-income households became the norm in the 1970s and 1980s, family income roughly doubled, but instead of that extra income creating savings, it got priced into the housing market, the school district premiums, the childcare costs. Families were earning more and becoming financially less stable because the market absorbed every dollar of the new income almost immediately. More money. Same trap, different architecture. So what does all of this mean for you? It means that your financial instincts, your sense of whether you are ahead or behind, your feeling about what you can afford and what you cannot, have been calibrated by a system that profits from your uncertainty. The paycheck cycle trains you to think in 2-week windows. The withholding system removes your ownership of money before you feel it. The fixed cost architecture ensures a baseline outflow that matches your income, and the social signals around status spending absorb whatever is left. None of this is inevitable, it is a design, and designs can be understood, and things that are understood can be changed. The investors and entrepreneurs who break out of this loop do not do it by earning more. They do it by restructuring how and when money moves through their lives. They pay themselves first, before any fixed cost touches their account. They delay the abundance signal by automating savings the moment income arrives so the brain never registers the full lump sum. They create income streams that arrive on different cycles, disrupting the bi-weekly rhythm the brain has been trained to expect. They treat their financial life not as a paycheck to be spent, but as a system to be engineered. The people who built the paycheck cycle understood something that most employees never learn. Predictability is power. If you can predict when money arrives and when it leaves, you can position yourself to capture the spread. Your employer does it, your bank does it, your landlord does it, your streaming service does it. Every institution in your financial life has built its business around the predictable rhythm of your paycheck. The question is whether you will too, because every 2 weeks money appears in your bank account, and within 72 hours most of it is gone. Now you know why, and now you know that the person who designed that rhythm was not thinking about your future, they were thinking about theirs. The only question left is whether you are going to keep living inside their design, or finally build your own.